Welcome to part 2 of Auditing Standard number 5. AS5 has over 100 pages, which is really heavy reading. Not very interesting. I'm going to make it easy to understand for the layperson. In this session, we cover role of risk assessment, scaling the audit, and addressing the risk of fraud.
This training gives context to SOX 404 requirements. It's meant to be an easy to understand breakdown of dense words, and because there's so many parts to the literature, I have broken it down to smaller parts, part 1, part 2, and you can see here based on your focus or the areas you're interested in, you can then listen to selected parts. And it's meant for people who need a refresher, or if it's your first time exposure to SOX 404, you can then get an overview. This table of contents came directly out of Auditing Standard 5 from the PCAOB. I've just made it into chunks so that it's easier to understand and follow. Let's talk about the role of risk assessment. So again, what I've done is added emphasis by highlighting certain words, keywords, and because you now know the background that AS2 was very heavy-handed, very prescriptive, you see a lot of comments throughout AS5 that talks about risk assessment. So the risk assessment that the auditor has to do is determine significant accounts and disclosures and relevant assertions, and also the risk assessment in selecting the controls that you want to test. And there's a direct relationship between the degree of risk and how much work that we have to do. And so in paragraph 11, you start to see where it basically says the auditor focus on the areas of highest risk. And it further says that even if an area is likely to have a deficiency or to have mistakes, it's not necessary to test those controls if it's not reasonable possibility that it will materially misstate the financial statements. So if you have a petty cash account that's $500, well, is it $500 or $200? Maybe we don't care. The risk that it's misstated is very high, but for $500, there are very few organizations where $200 or $300 is going to sway anything. So that's essentially what this focus is in terms of risk assessment and the discussion of risk assessment. And it then just basically wraps it up. Paragraph 12 just wraps it up to say the risk assessment depends on the complexity of the organization, the business units, or the processes. So it plays an important part in how much work you do and gives a lot of leeway for judgment to not do testing in certain area if it's not relevant to you. This section on scaling the audit, it's almost an extension of that risk assessment because it's saying that if your risk assessment is certain areas are not risky, it means that you can scale down the audit. And again, you hear over and over again in AS5 talks about right-sizing the amount of work, and that's because at the time that this legislation or this guidance was coming out, so many people were objecting to the cost of SOX, how it cripples the company and uses so much resources to do something that may not be value added if I'm a small public company. And you're telling me to do the same exact things as if I were a big company like an IBM, like an Apple, like a multi-billion-dollar organization. So scaling the audit talks about the size and complexity of the business, basically recaps what was just said in paragraph 12. And now you get the phrase risk-based approach. And you also then it says applicable to the audits of all companies, right? All public companies are now going to use the risk-based approach. That's why you hear the risk-based approach, this terminology repeated over and over again, because people are saying, look, we're going to start from the top down. What's our biggest risk? And then we decide what to do. Not here's a checklist of 50 things that every company has to do. That's it on scaling the audit.
Let's talk about addressing the risk of fraud. Because you know the background about the Enron scandal, you know why fraud is such a hot button. And this whole Sarbanes-Oxley, PCAOB, everything was around fraud. And that's why you'll see so many references to it, so many things focused on fraud. And as an extension of planning an audit, this paragraph 14 essentially says you must actively consider the risk of fraud, a material misstatement. Now, unlike FCPA or some of the other government types of legislation, this is focused around material misstatement of the financial statements due to fraud. And so it talks about the things, controls that you specifically have to address or highly likely to address, which is significant transactions that are outside the normal course of business. So many of you know that we oftentimes for our clients have a special process or a special section carved out for non-routine transactions. That's in response to auditors saying, hey, it says in this literature we have to consider the controls around significant transactions. And this is because most significant transactions are recorded through journal entries, they're recorded late, and senior level executives are likely to be involved. And so it just really, the root cause of it was Enron. Senior level people saying, just book this through, it's unique, the circumstances, whatever it is. That's why it's such a huge focus. You also want to focus around fraud, particularly for journal entries and adjustments. And that's why when you look at our financial statement close process, one of the key controls is always around journal entries and adjustments. Who's the person who prepares it, who's the person who approves it, and also controls around related party transactions. Remember Enron, that was all about creating all these shell companies that were basically related to each other, making money, basically selling to yourself and making and reporting money off of selling to yourself. So that's the reason for related party transactions, the emphasis on them. And then we have controls related to significant management estimates. That's why in most SOX audits, we focus on things like the AR reserve, the inventory side of E&O, that's excess and obsolete inventory, because that's where significant judgment from management comes in on whether you move a couple of hundred here or there. If you're making a good quarter, maybe you increase the reserve so you manage it for next year. There's a term in the accounting field called cookie jar reserves. So just imagine that cookie jar reserves during the good times. Maybe what you do is you increase some of your reserves so that it increases the expense on the P&L, and you put the accrual on your balance sheet. And then during the bad times, you release some of those reserves so that it decreases expenses and you have better earnings. That's why reserves or write-offs have so much scrutiny around them. And then lastly, controls that mitigate the incentive or the pressure for management to falsify or manage financial results. Again, a lot of these, the recurring theme is how do we prevent another Enron, another WorldCom from happening? And what you'll see is in paragraph 15, the reference to identifying and assessing. There's a particular auditing standard that talks about this, and that's Auditing Standard 12, identifying and assessing risk of material misstatement. So what happens in AS5 is it just talks about it, and then if you want very specific, very detailed references, you can then look up other literature specific to that. That's it around focus on fraud.